Good morning, YouTube. Got a video today about understanding futures. In some conversations I've had with people, they had some questions about either how the leverage works or how the math kind of works when you're calculating, stop loss and profit, because it's quite a bit different than stocks. So I had put together something a while back to kind of help me understand, and be able to explain better what exactly a futures contract is and how it works. So I'm just going to kind of go into a little bit. I'm not going to read this word for word, but I'm going to have it on the screen here, and you can pause it if you want to go back and read the whole thing. But I've got an example here of a few of the futures contracts that you can use. There's, I don't know how many, there's quite a bit, but there's only a few that are really liquid enough to get in and work with. Some of them don't have the volume, so it's really not worth it. But, the E-mini is probably, one of the most favorites, and then there's the micro also, which is basically just a tenth of the mini. Crude oil, and then micro crude. Some people also do gold. Like I said, there's a ton of them. You can go to your broker and get the list, and the amounts are different also. This is trade stations, futures requirements. So for them, for one ES Mini, you're looking at $1,166 that you have to have in your account. You're not actually buying it, you're just sort of controlling that contract. So in order to control one contract, you have to have $1,166. And TradeStation's higher than some of them. I've seen some where it's as low as a few $100s, $500 for a mini. So TradeStation, is a little bit higher. But anyway, so that's intraday. That's for like the New York session. You'd have to have $1,166. Overnight, it's 10 times that. They say that it's more subject to volatility and swings at night, which I don't know. A lot of the news releases are at 8:30 in the morning, which that's but an hour before New York opens. So maybe that's part of it. They don't want people having so much margin and ability to gamble on news releases, FOMC, non-farm payroll, days like that. So that was their explanation to me. Either way, it's 10 times as much. So just keep that in mind. If you're trying to do London or Asia, you have to have 10 times as much money to control those contracts. So generally, most of us can't do quite as much, during those sessions. So, we can't take advantage of as much of the opportunity because we can't buy as many contracts. So that's one of the reasons prop firms are good, because they give you so much money, more money to use. You can actually trade, those sessions and have a good opportunity to make a lot of money, because we all know London, you can make a killing, if you can use a contract or two instead of just one or two micros or what have you. So basically, futures are basically just contracts that are bought and sold agreements to provide a commodity at a set price by a set time. In the past, you had to be able to deliver the commodity, but not anymore. In fact, the brokers will even close your position for you if you haven't closed it by the time the contract expires. So they usually last a few months, plenty of time for day trading and swing trading. I'm just going to move down. These are some examples that I've got on my actual charts that I'm going to show you between Apple and ES to show how a similar move generates a different amount of profit. So like I said, I'm not going to read all this. I'm just going to put it up here. If you want to read it all, you can pause it. It's just some detail. I will go over some of the benefits, though. There's no PDT rule, which is for pattern day trader. So for when you're trading stocks, you have to have a minimum of 25 grand in your account to make unlimited trades during the day. If you have less than that, you can only make a few trades in a 5-day period, which means you're either holding overnight or, that's more of a, swing trader, longer term trader type strategy. So no PDT rule with futures, which that's great. Futures trade overnight and on the weekends, sort of on the weekends. I mean, Sunday night, it opens up. So this is great. I work third shift, so, I have different access to the nighttime stuff. Sometimes when I'm at work, I can trade London, which is cool. And more opportunity to get in. You got that extra session in London. So with futures, you have a lot more ability to be in the market trying to make money. So that's good. Tax advantage with futures, 60% of the profits are taxed at long-term capital gain rates rather than short-term rates like stocks. This adds up. So, anytime we can save money on, what they're going to tax us with, and this is in the U.S., I don't know about everywhere else, but In the U.S., your futures profits are taxed at a lower rate, so that's good. That adds up over time for sure. No wash rule. This one's hard to explain, but it just simplifies tax preparation and enables you to claim more of your losses as deduction. You can Google that for more information. I just did my taxes. I did them myself, and it was pretty painless. I got a 1099 from my broker, and I had 2 or 3 because I had just started and I went through some different brokers. But for the futures, it was really easy to do, and yeah, so I was able to deduct some of my losses because I wasn't profitable in my first year, obviously, and I saved a little bit of money that way. So one thing about the futures is you have a maintenance margin. So up here, I was saying you have to have so much in your account to control the contract. You also have to have a certain percentage over that to have for your drawdown. So if you have enough in there to just control one contract, but you go 10% in the hole, you're going to get a margin call. So as soon as you lose $100 here, basically $1,116, you're going to get a margin call because you drop below 10% of your margin. So that's just to protect them. You can go positive or negative quite a bit using futures. So you have to have more money in your account to be able to manage that drawdown. And there's a certain percentage you have to have, which is the intraday rate. And then this might be the overnight maintenance margin. So again, I would just Google that for more information. I understand it, but I'm not that great at explaining it. I just know that that's kind of how it works. So anyway, that's in a nutshell what the futures are and some of the benefits. Let's get into the pricing and trying to do the math for your stop loss and your take profits. So futures move in ticks, and it's no different than stocks. They move in ticks too. They just have a different amount. So on a futures chart, each tick is 0.25. This isn't necessarily money. This is ticks and points. You're not looking at the cost of anything. It's more the underlying asset. It might be the cost of that instrument. But when you're on an ES chart, you're not looking at something that's you're paying or using like $3,800 right here. So just forget that. Just consider it points and ticks. Okay. So I'm going to start the replay here, and you can see that as it moves, every movement of price is by 1 or more ticks. So this is expanded and slowed down quite a bit. I've got it at 10%, and I've got it way expanded. If this was, I'll show you. If I speed it up, just go to 100%. There we go. So you can see it goes through points really quick, right? 8, 7, 6, 5, 4. So just in these few seconds, it's dropped 4 points. Well, with one contract, that move is $200, $50 a point. So it started up here, it went down here. Just in the span that I've been talking right here, we're talking about $250, $300 worth of profit or loss. So you need to keep that in mind. The leverage with futures is, it's what makes it great, and it's what makes it terrible. The people that are good at it, they love the leverage. The people that aren't as successful, they blow up their accounts. So you really have to be careful because you can go through a lot of money really quick. But on the plus side, if you're wanting to day trade and make a living at this and don't have $100,000 to throw around, then futures is the way to go. So, and I'm going to show an example of how the leverage, how that's actually applicable. So let me pull this one over. Okay, I've got an ES chart and an Apple chart. This is Friday at 3 o'clock. Friday at 3 o'clock. So, since ES is the index, and Apple's a big part of the index, when Apple moves, the index moves. So basically, this move was the same time period on Friday for each instrument. So Apple had a move of 35 cents, right? So over here it would have been 35 ticks basically, right? Since each one of these is a penny, and that's how much the stock moves at one time, is a penny. So it moved 35 ticks. So if you would have had 1,000 shares of Apple, it would have cost you $164,560 to buy those shares. Okay? And it moved 35 cents. So 1,000 shares times 35 cents, you would have made $350 of profit on this move. But it would have cost you $164,000 to make that move. With ES, it moved 7 points. Okay, one contract costs around $1,000 during the day, but like I said, that's through TradeStation. You could get that at $500 somewhere else. It's a whole lot less, but it made the same amount of money. Okay, it still made $350 profit because it moved 7 points, and 7 points times $50 is $350. So that's what leverage is. That's the easiest way I can explain what leverage is. You're basically getting to use 100 times the value of what you put in. Okay, that's why the profit is so amazing with futures. And by the same token, if it would have went the other way, you would have lost $350 that quick. So it works both ways. It's a two-edged sword. So if you get proficient at this and you're consistent, then you're going to make a lot of money with futures. If you struggle and you can't find consistency, you're going to lose a lot of money with futures, especially if you're using full contracts. That's another good thing about the futures market is there's micro contracts, which the MES is just the micro mini, or the micro mini ES, and it's a tenth. So every point is only $5, and every tick is only $1.25. So if you want to practice and just have some skin in the game, you can use a micro, and you're not really going to hurt yourself much. If it moves a couple points against you, that's $10. You can really use wide stop losses, and for some people, and I've actually had success doing that because I can use a much wider stop. I know where the market's going to go sometimes. I just don't know the path it's going to take to get there, and I get stopped out. So when I use a micro, I've noticed, I'll give it a couple extra points because the difference between 2 points and 4 points is only $10. So I double my stop loss for an amount that's not really, it's not going to hurt me if I lose an extra $10. So I've noticed that seems to be a way to like I said, practice. You're not paper trading. You've got skin in the game. You're still dealing with the psychology of using money, but you're not using enough to hurt you. And it moves basically the same. It's very close. The ES, micro, and mini, very, very close, within a tick sometimes. But for the most part, they're going to chart the same. They're going to move the same. So hope that makes sense. That's what 100 times leverage looks like. You use 100 times less money with futures to make the same amount as you would in the stock market. Okay? So how does that apply to calculating risk, profit targets, things like that? So here's just, this is from Friday also. I've got a couple, this would have been sort of my play on Friday. We got our confirmation right here. You get a couple of rejections off the DR top, and I'm going to want to play this long. But where do I put my stop? Well, here's this low right here. I'm probably going to take this right here, under here. If I was, with what this is, I'd have probably dropped down even below the IDR. But just for the sake of argument, this is 2 points right here. This is a 2-point stop loss. 4102, 4104. With one contract, that 2 points, I'm risking $100. Okay? So for this amount right here, and when you're first starting out, it might just be easiest to deal with this in points. Every point is $50. Every whole number over here is $50. From 108 to 110, that's 2 points. That's $100. So you can see there's lots of $50 in here. There's lots of points, from 4106 just to where here is 21. That's 15 points. And, you could ride this out at least up to here before it pulled back, before the big pullback. When it pulled back here, people might have been pushing their stop up, or, depending on how they're trailing or how much room they're giving it. Even just up to here is 8 points, right, to 14, from 6 to 14, 8 points, $400 profit. And if you rode it all the way up to here, now you're looking at 15 points, $750 profit I'm rounding, but that's basically what this distance equates to in profit and loss. That's for one contract. So like I said, using the $50 per point to kind of understand where you're at is easy. If you're going to put on 2 contracts, then all you do is double it. You know, if you've got 2 contracts and you pull your stop loss back 2 points, now you're risking $200 because you've got 2 contracts, $50 each, $100 a point. 2-point stop loss, $200. Now your profit also doubled. So from 4104 to 14, 10 points. Okay, now you're at $100 a point profit. That's a $1,000 move with 2 contracts. So that's one reason this IDR-DR strategy is really appealing, is because when you catch these moves, this isn't scalping. This is picking up some pretty big moves when it moves up here to 1.0, 1.5 standard deviation. Yeah. So anyway, but if you expand this out, eventually it'll drop back to the tick amount, but you have to really come out and expand it pretty big. So there's what that looks like when it's expanded to where you can see each tick. And here's what your stop loss looks like at 2 points. Nobody probably looks at the chart like this. That's too big. So yeah. But as you'll get kind of familiar with what's a good stop. Something you can manage on basically any time frame. So on anything up to 5-minute time frame, a couple points is usually enough. When you move up to you're in 15-minute, hour time frames, not supported by this symbol. I don't understand why. Okay, anyway, this is the hour time frame. So now every little bit is now when you look at that same 2 points, right? That's what it looks like on the hour time chart. You don't have near as much room. If you tried to pull back to the nearest low, right, for your stop loss, you're 50 points, away. So you can't put on that kind of risk in an hour time chart. It's really hard to do that. So most people will, kind of get an idea of where they want to get in, what they want to see on a higher time frame, and then they'll drop into the smaller time frames, because that's where you're going to calculate your risk. That's where you're going to actually push the button to say buy and know how much you're risking. So on that hour time frame, that looked ridiculous. But if you drop down here to the 1 minute, now it makes sense. Or the 5-minute. There. There we go. So as you can see, most of the IDR boxes, I've got this set for regular trading hours. So each one of these is the New York session. And you can see they're pretty close as far as the size, right? So a couple points is always going to be, a decent amount. Like 2 points right here here's 950. There's 750. So that amount right there is 750. That's enough to work with, a couple points. I see when I watch M7's live streams, he'll go 3 or 4 points on a stop sometimes, sometimes more, sometimes less, but it depends on what you got to work with, what you're comfortable with. I would say starting out, you don't want to be putting on, huge amounts of risk, because you're going to be emotional. It's going to affect your judgment. Start with the micros, get used to winning and losing $5 here and there, and then when you switch to a mini, once you've established your strategy, once you're comfortable, you know what you're doing, all you're doing is up in the profit or loss 10 times. Nothing changes as far as when you push the button to buy or sell, and I think that's important. I wish I'd have known that when I started, because I would have saved some of my own money through the learning process, but I just consider that the fee for education. Let me see. I think that's probably about it. Yeah, $50 a point. $12.50 a tick if you're trying to figure partial points, like a 1.5 would just be 6 ticks. 6 ticks times $12.50, $75, or 1.5 times 50. just get used to dealing with the numbers 50, 1250, and you'll be fine. So that's about it. If you have any questions, hit me up. Thanks. Have a great day.